Hi, I'm Robert Maltbie, and Merry Christmas and Happy New Year from our office out west in Las Vegas, the second town that never sleeps, I guess, after New York City. So a lot to cover here as we move into 2025. We want to take a look at some of the thoughts about the valuations. Are we too high? Also, we want to talk about our proprietary private fund, the Argonaut 2000 fund, that currently ranks not only in the top 2% for the last 6 years, but also for the last 12 months. So we're happy about that as well. Particularly, it's been doing battle in a challenged asset class called small caps that have dramatically underperformed. So we're really happy with our performance. So let's jump in. Are we too high? Well, you can take it with a grain of salt here, because if you extract the Magnificent Seven, we truly have a market that isn't too high, trading at about 10 times earnings, but the projected growth rate, the trailing growth rate, are rather low, about 5%. So with that in mind, let's jump in and look at some historical parameters on the S&P. The S&P has experienced significant valuation peaks over the last 5 decades, often reflecting periods of economic exuberance, speculation, and transformative market events. What we're looking at here is the CAPE, developed by academic scholar from, I think, Harvard or Yale, doesn't matter, Robert Shiller. The CAPE is and it stands for cyclically adjusted PE ratios to smooth out the valuations over a 10-year trailing period. I'm not a huge fan of it, but it has its uses. It does tend to overestimate, going into big market turns, market highs. But anyhow, let's jump in. So the highest valuation known to mankind in modern times was the dot-com bubble in 99-2000. We had a CAPE ratio of 44, and that came in December 99. During the late 90s, we had a huge run, speculative investments, based on all the excitement with the initial growth in the internet. Technology stocks went to unprecedented levels. Many of these companies, Pet.com comes to mind, had no earnings, yet their stock prices soared. The outcome, well, as all good things come to an end, this came to a really bad ending. The bubble burst in early 2000, leading to a significant market correction that led to about a 40% drawdown by many measures. Next up, the second highest market of all time, the pandemic boom that we just experienced in 2021. 38 was the CAPE peak ratio in late 21. This was following the very sharp sell-off in the COVID market in March with the shutdowns. Aggressive monetary helicopter money and fiscal stimulus pumped up the market, and with very strong earnings, again, in technology and healthcare, a lot of stay-at-home stuff, borrowing from many forward years of assumed staying at home. Didn't happen. The outcome, rising interest rates and shifting sentiment in 2022, normalized valuations there. And the third highest pre-crash level, 1987. The CAPE ratio in the Reagan boom was 33 in August of 87. It was the peak of the 80s rally fueled by economic recovery and deregulation, and it peaked on right before Black Monday in October 87. And the outcome, the market did rebound quickly from that one, and the event kind of underscored the dangers of overvaluation and strategies like portfolio insurance. So where are we today? We can take salvation in the fact that it's only the fourth highest but it's isolated and driven really by the Magnificent Seven. And if you're not in the Magnificent Seven or a handful of tertiary or derivative type stocks and crypto, you're making maybe 5 to 10% overall. It's important to note over the last 3 years, the equal weighted S&P 500 is only up in the aggregate 10%. So it hasn't been a rip-roaring market for all stocks at all. So today, our CAPE ratio is 30. And of course, elevated valuations driven by the strong performance again in technology and AI-related sectors, despite a little tick up in interest rates and some geopolitical uncertainties. Investor enthusiasm for innovation and growth remains robust. So while comparatively, on average, there are lower historical peaks, a CAPE ratio of 30, where we are today, is significantly above the long-term average of 16, placing the market in a level of caution. So, some of the stocks, a narrow bifurcated market is very tricky, but it leads to a lot of opportunity moving ahead. And looking at a way that has benefited is our proprietary Argonaut 2000 partners. We've been well positioned in AI-related entities, select small caps, fintech, and crypto-related entities. Some of our top contributors, names like DeFi Technology, up over 500%, NVIDIA, up 171%, Bitcoin, up 161%. VRT, a utility that makes power to drive AI, up 161%, and on tennis shoes, that up over 112% for the year. So I like to quote a famous philosopher, John Lennon, "Get hedged because, as Lennon said, tomorrow never knows." So our fund is hedged. We're long short, and we've been able to drive this performance in an asset class as well. It's been tough, and we feel next year should be a tougher year, but we should continue to do very well. You can visit us at millennium-asset.biz for full information about the fund and its strategy. So please do that. In summary, just want to say that in looking ahead, you've got a lot of factors that are, I think, bullish for the other part of the market that hasn't participated, particularly small and micro caps. Big amounts of cash, 6.7 trillion, very much discussed, well documented, sitting on the sidelines. We have market factors with the incoming Trump administration. His policies should be very beneficial to small caps. Valuations very constructive, 12 to 15 times, and forward earnings estimates strong, 40% versus 15% for the S&P 500. So added up, looks like a place you want to start investing, getting more exposure to, because the market really needs to spread out, and we think it will. So visit our website for a trial subscription, get in front of some of these great ideas in the small cap arena. So visit us at singularresearch.com and sign up for a complimentary trial to get some of these new ideas. We're launching a lot of new ideas. So Merry Christmas, Happy New Year. 2025, years ending in fives. I'm kidding, I won't go there. We're looking for a lot of positive factors here for the market to spread out. I'm Robert Maltbie, Maltbie's Minute on the Market. Thank you.